Okay, jumping into Robinhood today, getting added to the S&P 500. Therefore, it is getting a solid boost between 10 and 15%. If we actually dive into what the actual price is, let's see, Robinhood up to 115. HOOY, the YieldMax equivalent, YieldMax fund with HOOD as the underlying, up about 6% or 9.45% today, or $5.88 per share. Big news, all of it, of course, driven by the addition of Robinhood App 11 and M-Core are set to join the S&P 500 on the next rebalancing on September 22nd, 2025. Therefore, all the S&P 500 ETFs and indexes will have to add these stocks. They are replacing Market Access, Caesars, and Enphase Energy. So, with all these funds forced, I guess, by their prospectus and whatnot, and to add these funds, Robinhood's getting a massive boost. For those who own Robinhood, just want to take a look at how it's structured. Today, of course, Robinhood employs a synthetic, or HOOY, I should say, the YieldMax ETF employs a synthetic strategy where they buy calls and sell puts to mimic the performance of HOOD, the underlying. And by doing this, it gives them collateral to sell call options against it to generate equity or generate premium. This morning, I guess, before the news was announced, you can see what they had sold here. They had a bunch of calls sold at, let's see, 102, 103, 105, 106, and even up to 109. Robinhood has blown past all those estimates, so they capped their upside. This is a good example where they capped their upside. However, they are employing the covered or the credit spread method where they sell calls, but they also buy calls at higher strike prices. Therefore, as we can see here, they got calls bought at 110, 111, 114, 115, and even out to 117. Other than the 117, we've hit everything. So even though HOY was capped on their upside up to 109, once Robinhood kept going up, we're actually hitting these call options again. So we're capturing all the upside in parts as we continue to go higher. We'll capture full upside for anything past 117. So therefore, you can see Robinhood's up 14.54%, but HOOY's up 9.45%. That 9.45% is greatly elevated because we got these credit spreads. If we didn't have these credit spreads, we'd be much lower than that. So employing the credit spread method, in my opinion, is a good approach, because when you get these big booms or big jumps in the stock price, you do lose out some of the upside, the trade-off that is applied for capturing premium. However, you do start capturing upside once again once it flies past the upper side of the credit spreads that you bought, which in the case of Robinhood is happening today, and we'll continue to see how it performs the rest of the week. But for holders of HOOY, we want Robinhood, the underlying equity, to continue going higher because we are capturing full 100% upside, I guess, once we get past 117, as if we were owning the equity outright. And we also get the yield component as well. So please keep going higher for holders of HOOY. Perfect example of how the credit spread method is allowing a user to capture equity, but at the same time, capture the upside in case there's a massive move upward. So good day for Robinhood investors as well as HOOY investors. As far as those who hold HOOY, how it's performed, I guess if you go to the HOOY tab on my website, which I'll provide in the link below, but it provides basically an overview. This might be a day old, so we'll refresh it tomorrow to see get the exact comparison. But for those who have owned it, we have HOOY is part of, let's see, Group C here. So Group A just announced. Group C announced not this week, but the next week. Since its inception, HOOY has paid out 4 dividends. You can see what these are exactly. It came out at an average price of 50 and has paid out an average monthly dividend of $5.14. So for those who are quick with the math, you can see that since distribution has been paying over 10% distribution every month. If you come and see the price plus cumulative distribution for those who bought in at 50, they've already received over 40% of their money back at $20.56 for every $50 they've invested. It's already come back in form of a distribution. And not only that, but you also have a fund that started out at 50 and we're up to as of the last dividend, it was 67. But we know right now, I guess if we go to the HOOY details, which I already showed, so it's 67 the last month, but right now we're at 68. So the fund itself is at 68. So that's $18 on top of your $50 that you have as a return on just the ETF component. So this is definitely an example of where the YieldMax strategy, although is underperforming relative to comparison to owning HOOD, the underlying equity, overall it's been a really good investment for those who owned it. So for all the people that dislike some of these funds, For people looking for income, HOOY has been a good example of a good fund that you can own. It surprisingly gets NAV appreciation as well as a very good distribution, at least for the start of this fund. Just a thing to note, I want to go back to the in-depth details of what this fund is holding. So you can see, luckily, I already went over, this was the stock price of where it was this morning. There's synthetics at 105. So with HOY shooting above, or no, I should say Robinhood, the synthetics set at 105. So with Robinhood shooting to 116 now, the synthetics clearly in money. So my data is aged by a few hours. So you can see if you go to the fund makeup per share, the synthetic was originally a $2 hit to the fund, but right now it will be positive. Therefore, shooting this ETF price from 62 up to 68. A lot of that driven because the synthetic went from -2. And we'll see if I refresh the data, but it's well above a few bucks a share. And then from a synthetic usage risk, this is what I'm happy to see. Robinhood did have the ability to write 22,000, or the HOOY fund managers, I should say, who employ HOOY as a ETF fund with Robinhood as the underlying equity. They had the ability to write 22,880 contracts to generate income via calls. They wrote those, they used them all, so they had a remaining capacity of 0. However, they employed a credit spread method in 100% of those. So they bought 22,880 contracts at a higher strike price. Luckily, they did that because we're reaping the reward on that for HOOY investors, because we are starting to capture the upside again. So this is great news, as I went over before, but it's good to see that 100% insurance percentage. Once we refresh these tomorrow, you can see that all these illustrations will update drastically. Specifically, you'll see the synthetic shoot up. However, the cost of the contracts that they have sold will also shoot to be a negative value. However, the synthetic should make up for what the negative value is. The negative value will shoot down to reflect the calls sold, but then it will rebound and come back, if you're watching in real time, to a less negative value because of the calls we bought on the credit spread method. So I'll be interested to see how these figures move upon refresh at the end of the day. And then one thing I did want to note, so I got the positioning here. Another tab I did add was the previous position, or position previous iteration tab. Basically, this shows, positioning shows today's positioning or holdings for the ETF. The previous one shows what it was the day before. So if anybody's interested in like, how do they move? So this would be last Friday. You can see what they held. They did sell some contracts out on September 12th. They had them last Friday. So you can see, for example, at the 109, they had 1,300 shares sold. If we go to today, I see at the 109, they still have those 1,300 shares. The other things they did is when all those other contracts expired, probably on Friday, they sold these calls, which have all been blown by, but luckily they bought these calls here. So credit spread method employed perfectly. Of course, it would be nice if the calls they sold were at slightly lower strike prices. But generally speaking, when they employ this strategy, they do expect all of these credit spreads that they buy, for the most part, to expire worthless on a normal volatility week. However, in the high volatility weeks, what the money they spend on these is a very wise investment, as it multiplies itself several times over when you get the big moves of 15% in the other line and 10% to the HOOY. But anyway, yeah, for HOOY investors, I will update these charts the next trading day, of course, and all these graphs will move exponentially. As far as what their holdings are, you will see that their cash holdings may stay the same or relatively the same. However, you'll see the synthetic, I guess, go from a negative here. It will jump massively. The other contracts will go down somewhat, not as much as the synthetic will go up, but it will also push the ETF market cap probably up to about 68 or so. So just as people want to understand how these funds move, what are the benefits, what are the positives, HOOY today, with the inclusion in the S&P 500, gives a good example of how the credit spread method will give you premium, and then in the case of extraordinary moves, we'll cap your upside somewhat. You can see they not get the full bang, but getting 10% of a 15% move is not the worst option for those who are willing to trade some